the next dividend model, that is Wlaters dividend theory. So as per Wlaters dividend theory, it's not like Modigliani and Miller theory. Modigliani Miller theory was an irrelevance theory, and Wlaters dividend theory is it's a relevant theory. Walter says that the dividend policy will definitely affect the value of the firm, and hence the dividend policy is relevant to the value of the firm. So this model is developed by James C. Walter, and as per him, the dividend policy affects the value of the market price of shares and thus affects the value of the firm. He stated that the investment decision and the dividend decisions are interrelated. That means the firm may pay dividend or not is totally based on whether it has suitable investment opportunity to invest the retained earnings or not. So Walter says that the dividend policy will affect the market price of the share and the value of the firm, and the dividend decision and the investment decisions are very much interrelated. So a firm will decide whether to pay dividend or not to pay dividend based on whether it has investment opportunity or not. So if investment opportunity is there, then definitely the firm will pay no dividend and it will retain the earnings and it will invest in those investment opportunity. If there is no investment opportunity, then there is no meaning in retaining the earnings. So they will pay off the dividend. This is what Walter's dividend theory says. Now we can move on deep into this theory. As per Walter's dividend theory, there are mainly two concepts, that is KE and R. So we can see what is KE and R. When dividend is paid, shareholders will get immediate money. The shareholders will get that immediate money and they will invest that immediate income to get further returns. So that expected rate of return on that dividend income which is invested is not KE. So when dividend is paid, definitely they will get immediate money, and the investors will invest that immediate money in some other investment opportunity, and they will expect a rate of return from that investment, and that rate of return is known as KE. So when dividend is not paid and that is retained earnings, and that retained earnings will be reinvested by the firm to get a return on this investment, that rate of return on the retained income which is reinvested is R. So we can say that KE and R both are two kinds of rate of return expected. KE means the rate of return expected by the investor on the dividend income which is invested in some investment opportunity. R is the expected rate of return expected by the firm on the retained income which is reinvested in the business. So these two concepts KE and R is very important, and the Wlaters dividend theory is based on this KE and R. The Wlaters dividend theory says that the dividend policy of the firm depends upon the relationship between KE and R. Thus a firm can maximize the market value of shares and the value of the firm by adopting a dividend policy as follows. So the Wlaters dividend policy is totally depending upon the relationship between R and KE. So you must have a clear-cut idea about these two concepts KE and R. KE is the rate of return expected on the dividend income which is invested, and the R is the rate of return expected on the retained income which is reinvested. So if R is greater than KE, that means the return on the retained income which is reinvested in the business is greater than the rate of return on the dividend income which is invested in other opportunity. That means it is better to retain because the rate of return is more for R than KE. In such cases, it shows a growth firm. There is more possibility for growth, and in that condition, because it is worth in reinvesting and it is worth in retaining and reinvesting. That means when R is greater than KE, there should be 0% dividend payout, 100% should be retained for reinvesting in the business because the firm is showing a growth tendency. If R is less than KE, KE is greater, that means it is a declining firm. That means there is no further business opportunities are there for reinvesting. So there is no meaning in retaining. So retaining ratio is 0% and 100% of the earnings should be paid as dividend. If R is equal to KE, that means a balanced firm. That means the dividend is irrelevant and the dividend policy is not expected to affect the value of the firm. Okay, so if R is equal to KE, so if the whether the firm pays dividend or not paying dividend, the value will remain same. If R is greater than KE, it is better a firm which is paying, which is more retaining more will have greater value. If R is less than KE, a firm which is paying dividend will have greater value. This is the Wlaters dividend theory. Now we can see a formula that is related to Wlaters dividend theory, that is equal P is equal to D plus R divided by KE into E minus D divided by KE. We can see the different forms of the equation, that is P is equal to market price of share, D is equal to dividend per share, R is the internal rate of return, K is the cost of equity capital, E is the earning per share. And please refer the text for assumptions of Wlaters theory. Now we can see a problem and we can see the impact of Wlaters dividend theory through a example question. See the question. The following information is available in respect of a firm. The capitalization rate, that is KE, is equal to 10%, earning per share is equal to 12, assumed rate of return on investment, that is R values is first case is 16%, 8%, 10%. Show the effect of dividend policy on market price of shares using Wlaters model at the following different payout ratios. Payout ratios is 0%, that means dividend is equal to 0, 50%, 75% and 100%. So let's see the question. Here we can see that we are calculating it in 4 different cases: when dividend payout ratio is 0%, when dividend payout ratio is 50%, when dividend payout ratio is 75%, when dividend payout is 100%. So in 3 different cases we are calculating the market price of the share. So when dividend payout ratio is 0%, that means dividend is equal to 12 into 0 by 100 is equal to 0. This 12 means we know that 12 is the earning per share. So if dividend payout per share is 0% means 12 into 0 by 100 into 0 by 100 is equal to dividend is 0. So applying this equation, we know that D is equal to 0. R is already given in this, that is 16%, that is 0.16, divided by KE, capitalization ratio rate is given, that is 10%, 0.10, into E minus D. E is already given, that is 12 per share, minus D is equal to 0 divided by 0.10. And when R is equal to 8%, instead of this 0.16, it is changed to 0.08. And when R is equal to 10%, we can see that 0.10 is taken. See the values. When we are computing, we will get P is equal to 192, P is equal to 96, P is equal to 120. Now we can see the when dividend payout ratio is 50%, that means D is equal to earnings per share is 12. So 12 into 50 by 100 is 6. So substitute D of 6 in all this formula. Instead of P is equal to D, here 6. You have 16%, so 0.16 divided by 0.10, 12 minus 6. Here R is different, 8, so it's 0.08. Here 10, 0.10. So when we calculating, we will get the market price of share is equal to P is equal to rupees 156, P is equal to rupees 108, P is equal to 120. Like that, when dividend payout ratio is 75%, 12 into 75 by 100, here dividend is equal to 9. So substitute the values, we will get the market price of shares in 3 different rate of returns. Like that, when dividend payout ratio is 100%, that means 12 into 100 by 100, 12. So substitute the values, we will get the new values. Now we have calculated the market price of shares in different ways. Now see, we know that the KE value is 10% in all cases. So in this first case, here look at this, R is 16%. So when R is greater than KE, what happens when the dividend payout changes? see, this is three sections. So we can see this first section, then this second section, then this third section. So the first section where R value, that is 16%, is greater than KE, that is KE means 10%. R is greater than 10%. So what happens when dividend is not paid and when dividend is paid? So when R is greater than KE in this first case, we already said that when R is greater than KE, it is better to retain. It is better to retain the dividend and not to pay any. It is better to retain the earning than not to pay any dividend. So what happens? When is the price of the share is maximum? When R is greater than KE, the maximum price, look at the first case, 120, 138, 150, 192. When the dividend payout is the least, at that time the market price become the highest. And when the dividend payout is maximum, the market price of the share is the minimum here. So that means when R is greater than KE, when R is greater than KE, it is better to retain the earnings and to pay less dividend to get maximum share price. When R is less than KE, what happens? When R is less than KE means here R is 8%, KE is, we know that it is 10%. So R is less than KE. See the different cases. When the we know that when R is less than KE, it is better to pay out the dividend to get maximum value for the shares. So here when R is less than KE, the market price of shares when dividend payout is 0% is the minimum 96. When the dividend payout is 100%, look at the market price of share is 120 here. Compare the values 96, 108, 114 and 120. So when R is less than KE, the maximum value reached when the dividend payout is 100%. When R is greater than KE, the maximum value of dividend reaches when the dividend payout is 0%. And see what happens when R is equal to KE. That means the dividend payout is irrelevant. If the dividend payout is 0%, 120 itself. If the dividend payout is 50%, 120 itself. If the dividend payout is 75%, 120%. And if the dividend payout is 100% also, the value of the market price of the share is 120. That means when R is equal to KE, it is balanced firm and the dividend policy is irrelevant. We can conclude it. When R is greater than KE, that means R is equal to 16% and KE is equal to 10%. The market price of share is maximum 192 when 0% dividend payout and the market price of share is minimum 120 when 100% of dividend payout. That means it is a growth firm. When R is less than KE, that means R is equal to 8 and KE is equal to 10. The market price of share is maximum, that is at 120 when 100% dividend payout, and the market price of share is minimum, that is 96 when 0% dividend payout is paid, that is declining firm. When R is equal to KE, the market value of share remains same, that is 120 in all dividend payout ratio. So we must understand that whenever the R is greater than KE, that is a growth firm, it is good to retain the earnings and pay low dividend to maximize the value of the share. If R is less than KE, that means it is a declining firm, and in order to get maximum value for the share, it is better to pay out the dividends and keep less retained earnings. And if R is equal to KE, there is no matter in paying dividend or not paying dividend or keeping retained earnings or not keeping retained earnings, the value of the shares remains the same. This is how we can explain the Wlaters dividend theory. Thank you.